This is Andrew Stotts of A Stotts Investment Research here for another Valuation Masterclass case study. And today, the question that we're going to ask is Ralph Lauren's polo shirt worth more than its share price? Well, we're going to explore that. Let's take a look. Again, this is Andrew Stotts of A Stotts Investment Research, and welcome to the Valuation Masterclass case study, where we dig into interesting stocks and their valuations. Today's company is Ralph Lauren. Everybody has been to a mall or a store and been to this type of shop. It's just beautiful, a high-end retailer. Now remember, this video is for learning purposes only. This is not investment advice or a recommendation. So I'm titling this one, Strong Profitability but Low Growth in a Competitive Industry. Here's 3 things you need to know about Ralph Lauren. First, sector leading margin is reaching a peak, and they're shifting away from wholesale, and this is increasing brand value. And with profit back on track, I expect rising share repurchases. Now, there's 22 analysts covering the company, and they've got an upside of 21.7% and a share price target of 140 and a buy recommendation. The price to book value of the company is 3.5, and dividend yield is about 1.8. Not a bad dividend yield, I must say. Now, my estimate is $96. That's a downside of 16.5%, or if it was recommendation, it would be sell. But let's try to look at where I come up with that. But before we do that, let's look at the share price for a while. We can see the share price movement has just kind of been flat. And in 9 months, 2021, Ralph Lauren has seen a strong price rally with the 50-day moving average staying above the 200-day moving average. However, the 200-day moving average closed the gap, and it seems like it could cross the 50-day moving average very soon. And this could mark the start of a bearish trend. So let's talk about the sales of this company. How do they derive their revenue? Well, first of all, revenue breakdown for 2021. What we can see is retail sales is 63% of total sales. They have about 548 retail stores and 650 concession shops. Wholesale is about 34%, and licensing is a paltry 3%. The breakdown by region, well, 45% in North America, 27% in Europe, and 23% in Asia. That's a pretty impressive geographic distribution, so that reduces some risk. So what's the story here? Well, first story is sector leading margin is reaching a peak. You can see in this chart that Ralph Lauren is the red line, and the red line is just starting to rise up to and slightly above, actually, Hermes. Hermes is probably the most profitable, let's say, premium product brand out there. Ralph Lauren had an impressive improvement in gross margin, which recently converged to the profitability of luxury manufacturer Hermes. A higher contribution of online sales boosted the gross margin. However, there's not much further room to improve, and we think that the market already acknowledged this past effort on margin. I mean, how much more can you increase your margin? And I think I would just like to talk about that for a second. What I'm trying to do when we're valuing a company is say, where is the growth potential? One of the ways to get growth is expanding your profit margin. But if you're already super high, there's not a lot of other ways to do it with profit margin. The other way to do it is through revenue growth or cost control. And we'll look at that in a little bit more detail. So let's get back into the slides. Now, many analysts are overly optimistic about their gross profit margin. So let's go through how to avoid being overly optimistic in your gross profit margin. First, analysts tend to be overly optimistic. And at some point, companies face a ceiling where they cannot further improve their margin. In the case of Ralph Lauren, it seems like the company is converging to that point. Be careful when forecasting gross margin, because even a small change, like even a 1% increase, can have a massive impact on the net profit. So you saw that in the prior chart that Ralph Lauren has improved significantly But that significant improvement still is a very small amount. So gross profit margin doesn't change that much. Now, number two for the story, it's shifting away from the wholesale, and that's increasing its brand. You can see the retail is rising from about 50-50 almost up to about 65%. So wholesale partners tend to offer large discounts when reselling, and that's devaluing the brand. The company gets better control of the prices by tightening the supply. This will allow Ralph Lauren to increase its retail prices, which are the company's main driver of growing revenue in the future. Now let's look at the story number three. With profits back on track, expect rising share price repurchases. This chart shows the red line, that's the amount of share buybacks in millions of dollars, and the net profit is the blue line. Ralph Lauren's share repurchase program is closely linked to its profit generation. This means when profits are good, the company returns that profit to shareholders. It announced to resume the program in second half of 2022 onward, with still $580 million left that are authorized for repurchase. Now, if you just look at this period on this graph, let's forget about 2022 and 2023 because those are forecast years. Let's just look at 2021 going backwards. If you would just add up the net profit and the share buyback, they're about equal. So they're buying back about as much profit as they're making. So given that Ralph Lauren uses pure cash for its repurchases, it has an accretive effect on EPS. Now, we're going to upload the slides of Ralph Lauren here on our blog afterwards. You can go to that link right there to see it, or you can just go to valuationmasterclass.com and go to the blog menu. All right, let's continue. Let's look at the FVMR scorecard. It measures a stock's attractiveness relative to all other companies. And attractiveness is based on 4 elements: fundamentals, valuation, momentum, and risk. The scale is from 1, which is best, to 10, which is worst. So how does a company rank? Well, I'm going to focus in on the strong one, momentum. That's the strongest one. Risk is the lowest. And that's mainly because the company has a lot of volatility in the share price. But let's look at momentum. We can see revenue growth has recovered in the past 12 months, as well as operating profit change and recurring EPS. So it has been a strong recovery. So recently I created a short online course explaining my FVMR investing approach. It's a $97 value and you can get it for free. Just scan this QR code and check it out. Now, let's talk about the forecast. Consensus remains optimistic regarding profitability turnaround. There's 22 analysts covering the company, and there's an upside of 21.7%. However, analyst consensus sees upside, but most of them still have a hold recommendation. In fact, if we look at that, I'll just go into that particular area. And here we can see 10 analysts out of 22 have it as a hold, right? Now, the point that I would make is, what does a hold mean these days anyways? Really, it probably means sell, because analysts don't like to say sell or strong sell. So you can see that here. And they expect the company to maintain the increased gross profit margin and even expand it by 50 basis points through to 2023. So they're pretty optimistic on their forecast, but not particularly optimistic on their recommendation. So let's take a look at the financial statements and just look at the highlights. On the P&L, net profit sees a strong rebound and exceeds its pre-pandemic level. We can see it's gone from negative in 2021 up to 658 in 2022, which we're expecting. Both higher revenue and margin expansion contributed to the strong bottom line. And also, the company has a massive cash position, holding around 33% of its assets in cash. This is super helpful going into the crisis. And the strong cash generation ability makes us assume that Ralph Lauren can resume its previous share repurchase program. So let's look at the liabilities of the balance sheet. Large profits in 2022 and 2023 that we're expecting will allow the company to repay part of its previously issued debt. But really, the company doesn't have that much debt when you look at the amount. Just go back to there. You can see the cash and short-term investments was about, by 2021, it was 2,777. And here we can see that long-term debt was 2,003 in 2021. So debt is not an issue for the company. Let's look at the cash flow statement, and we can see strong operating cash flows allow the company to pay out dividends, which are in line with its pre-pandemic policy. We expect that the dividend yield over the next term is going to range between 2 and 3%. Now, remember, if you have any question about the company, feel free to ask in the chat. Revenue, I expect a rebound in 2022, and we assume revenue growth to normalize. Going forward, we see the revenue growth potential between 3 and 4%. Let's look at ratios here. EBIT margin is likely to expand significantly through better cost control. I mean, look at that EBIT margin going from 6.6, 4.5, and then up to 15%. We see an EBIT margin around 15%. It's really the maximum. We are being optimistic on that side. And so we're already have an optimistic bias. Let's look at the valuation. Now, before we go into the valuation, I want to think about what is this company's long-term share price performance potential. Really, it's driven by two factors. The first is the concept of internal earnings. How much can they generate? And let's look at that breakdown. Basically, the drivers of earnings are price, quantity, cost of goods sold, and expenses. Now, what about price? The potential for price being a factor that could drive earnings is pretty weak because retail price faces mid-single digit growth. They're already kind of premium priced, so I don't see a lot of price appreciation. Quantity, well, it's also kind of weak. I mean, unless they announce some massive strategy to expand. It's not like they have 50,000 stores, but they do have a lot of stores, and there's intensified competition from new entrants. So unless they announce that they're going to be implementing some big growth strategy, it's pretty weak. Costs, moderate. Gross margin already is close to its peak, so I'm not really sure how much better they can do on cost of goods sold, but let's see. And then expenses, I would say, are weak. Marketing expenses are likely to increase. Annual EPS growth is likely to be around 5% between 2022 and 2025. So I wouldn't say that the internal driver, meaning earnings, is going to drive the share price. Let's look at the external, and that is really how much it could re-rate. So first, let's look at the driver of the PEG ratio. Here we can see that the company already trades in line with U.S. consumer discretionary companies, and therefore I see kind of a weak opportunity for PEG ratio to expand. And the price to book relative to ROE or just price to book, it's not bad. It trades cheaply compared to the U.S. consumer discretionary. If we add all these things up, I would say that there's not a lot of opportunity for growth and share price performance over the next 5 years or so. So no premium over sector is justified. Yeah, and I see a comment from Lee. Actually, Lee and I talked about this particular page just yesterday, and I've put it into action. That's pretty exciting. So here's free cash flow. Let's look at what we come up with. What you can see is over the past years, Ralph Lauren has proven its consistent cash generation ability, and there you can see it. There's no indicator to assume differently for the future. Yeah, Pusaporn says, I love their bear shirt. Yeah, nice. All right, so let's look at the value estimate. The consensus and my assumptions, not that much different. I mean, the volatility in their earnings is not that different. It's similar to a consensus. We expect a strong gross margin. The revenue growth CAGR might appear huge, but mainly driven by a rebound effect in the current year. So we're using a valuation method of the free cash flow method. And basically, the conclusion is a 16.5% downside is my base case. And the bull side is still a downside, but only 10%. And the bear case is a downside of 23%. So let's look at the world-class benchmarking scorecard before we wrap this up. This identifies a company's competitive position relative to global peers. The combined composite rank of profitability and growth we call profitable growth. And we look at it from a scale from 1 best to 10 worst. So here you can see that it's ranked, well, you know, I say among the worst in the world, but I would say when you compare it against 1,040 large consumer discretionary companies worldwide, it's kind of average right now. 4 would be slightly above average. And so I think, you know, it has improved a bit. So I'm looking at that. And here we can see that the profitability has actually hit about average for the past 12 months. And it's revenue growth that's really rebounding right now. And remember, when I talk about profitability and growth, when I talk about growth, I'm talking about EPS growth. So not a bad performance, but not top of the game. And that really tells you there is some potential to improve, but I would argue that that's going to be hard going from here. So what are the risks? Well, key risk is falling behind in online sales, intensified competition from new entrants and urban lifestyle brands. Adverse economic conditions could hamper the cyclical consumer discretionary sector, and failure to meet growing demand for e-commerce is a risk. So let's wrap it up. Here you can see that analyst consensus is about $140 and I'm at about $96. This is what we're trying to do in the Valuation Masterclass case study, is look at the situation in the company. So the conclusions are weak potential to drive earnings growth internally. They're already doing so darn good that we only have to look for if the management can really announce some big growth expansion. Strong margin expansion is already acknowledged by the market, and dividend yield and share repurchases are not significant or sufficient to compensate for the lack of the upside. So my question to you is Ralph Lauren's polo shirt worth more than its price? And that's the question. Hopefully you can leave a question in the comment. I'm happy to get back to that. And hopefully you can gain from this research and this Valuation Masterclass case study.